Hi clients and friends, Mike Brady here. This week I want to talk about reverse mortgages. Before I get into that technical discussion, I promised my mom I would smile more. I just get excited about what we're talking about. I have a tendency to talk fast and forget to have some humor about some of these serious topics as well. So I promise I'll try to smile a little bit more for this week's video. A reverse mortgage is, it's as its name says, the reverse of a traditional mortgage. A traditional mortgage is you have very little equity in a house, maybe 20% down, 80% that's going to be financed in a house. Maybe you have a job and you're going to pay off that 80% that the bank is loaning to you with your earnings. You're having a job and they basically take a 30-year bet on you that you'll make the payments on a monthly basis, okay? A reverse mortgage is when you're older in life, you have to be 62 years old at least, and you might not have a job. You have fixed assets, meaning that you have something like personal residence, and you can't, but you don't have many liquid assets, and so you can't sell off a room of the house to buy bread for the year. So how do you get money out of brick and mortar so that you can pay for your needs? And since you don't have a job, banks a lot of times don't want to loan you money. So one of the options, and I do want to say this is one of the options, and it probably ought to be the last option, is a reverse mortgage. It's nice to know that it's there, but it's definitely not something that you go into without a lot of research. But a reverse mortgage is where you go to the bank, they say that they will give you some money, you don't have to make monthly payments, there's a lot of upfront costs, but you pay back the loan when you pass away. So if you, let's say that you're 65 years old, they give you a certain percentage of your house in cash that you don't have to make monthly payments, and if you were to die at 75, let's say, your heirs would either keep the house and pay off the loan with other assets, or they would sell the house and the first debtor, first lien holder would be the bank. One of the disadvantages is you have a lot of upfront costs. They've really been touted in the last decade or so, probably as a cure-all, and it's no problems, but then people forget that they're accruing interest on the unpaid balance, and it wasn't properly understood. So my recommendation is that if you find yourself with lots of fixed asset, a lot of equity in your house, but no liquid assets, at least explore it, but really take it slow. Here in Boulder County, you're required to go to a 45-minute to an hour consumer advocacy meeting before you can even go forward on it. I think that makes a lot of sense to make sure that you've explored all your other options, but if you've exhausted all of them, then that this is actually an option. So anyway, give me a call if you have any further questions, you want to discuss it further. 303-747-6455. Hopefully I remember to smile. I am a QA3 registered representative, and you have a great week. Bye-bye.